Curious about the reversal signals lurking within the U.S. economy at the close of 2023. On one hand, employment is rebounding. On the other, manufacturing continues to contract. Service sector orders surge dramatically, yet inflation unexpectedly cools. Behind these seemingly contradictory figures lies the key to structural recovery. Today, we dissect this economic report that has divided Wall Street, uncovering the core logic guiding market direction. The December 2023 U.S. economic data released a perplexing set of signals. Private sector employment unexpectedly rebounded, yet manufacturing remained entrenched in contraction. Service sector orders surged substantially, while price growth paradoxically moderated. This seemingly fractured data prompted rare divergence among Wall Street forecasters. Some interpreted it as clear signs of a soft landing, while others cautioned it might merely be a temporary stabilization before recession. As more granular data and industry feedback emerged, a structurally differentiated recovery landscape dominated by services yet fragmented across sectors gradually emerged from the fog. December 2023's private employment performance in the U.S. served as a crucial barometer for economic trends. ADP data revealed 41,000 net new private sector jobs, marking a notable rebound from the previous month's revised figure of 29,000 job losses. However, this figure remained below market expectations of 50,000. From the perspective of overall labor market conditions, this figure falls precisely within the commonly accepted neither hot nor cold range. It neither indicates overheating that could trigger inflationary pressures, nor suggests excessive cooling that might signal recessionary tendencies, thereby affording reasonable scope for macroeconomic policy adjustments. Notable disparities in employment performance across sectors underscore the structural nature of the recovery. The goods-producing sector continued its previous weakness, shedding 3,000 net jobs in December, with manufacturing the core component of goods employment remaining the primary drag. This phenomenon is not a short-term anomaly but rather the combined effect of a prolonged, high-interest rate environment and sluggish demand. A survey released by the National Association of Manufacturers at the time revealed that over 60% of manufacturing firms cited insufficient orders and elevated financing costs as their primary operational pressures. Within specific manufacturing sectors, durable goods production, highly sensitive to interest rates, exhibited particularly sluggish performance. Subsectors, including automotive manufacturing and machinery production, all experienced varying degrees of employment contraction. The automotive sector alone saw a net loss of 12,000 jobs that month. This strongly corroborates previously released manufacturing PMI data, with the sector's PMI remaining below the boom-bust threshold at a low of 47.8. Both the new orders index 45.2 and production index 46.4 remained in deep contraction territory, indicating that pressures on the production side of the real economy have yet to be effectively alleviated. Nevertheless, the market maintains positive expectations regarding the future trajectory of manufacturing, as the effects of interest rate cuts in the first and second quarters of 2024 gradually materialize. Operational pressures on interest rate-sensitive sectors are anticipated to ease, coupled with the spillover effects from the subsequent recovery in the service sector and the stimulus from tax reduction policies. The current weakness in the manufacturing employment market may gradually subside. The Economic Outlook survey report released by the Federal Reserve at the time also indicated that most regional Fed banks held cautiously optimistic views regarding the recovery of manufacturing after the second quarter of 2024. In stark contrast to the weakness in goods sector employment, the service sector emerged as the core driver underpinning private sector job growth that month. It contributed 44,000 new positions in December, accounting for 107% of the total private sector employment increase and fully offsetting the drag from goods sector employment. Within the service sector, performance varied across different segments. The education and healthcare industries, with their pronounced defensive characteristics, once again served as employment stabilizers, contributing 39,000 new jobs in a single month. The steady growth in this sector stems from its inelastic demand nature. Even during economic fluctuations, demand for education and healthcare services does not experience significant contraction. Data from the U.S. Department of Health and Human Services indicates that healthcare employment growth remained consistently above 2.5% throughout 2023, significantly outpacing overall job growth. The strongest demand for workers was observed in elderly care and specialized medical services. The leisure and recreation sector contributed 24,000 new jobs that month. though this increase was largely attributable to seasonal factors driven by year-end holidays. Historical data from the U.S. Bureau of Labor Statistics shows that from 2018 to 2022, the leisure and recreation sector averaged 21,000 new jobs in December each year, followed by an average loss of 18,000 positions in January and February. This pattern demonstrates pronounced seasonal fluctuations. Consequently, as the New Year holiday effect fades in 2024, these additional jobs are likely to decline in the coming months. In contrast, employment conditions in professional services and information technology continue to deteriorate. These two sectors accounted for all net job losses in the service sector, collectively contributing to a net reduction of 41,000 positions. Within IT, net job losses reached 23,000 that month, predominantly in foundational roles such as software programming and data processing. A report by U.S. employment consultancy Challenger, Gray and Christmas indicates that tech sector redundancies hit 28,000 in December 2023, marking the sixth consecutive month exceeding 20,000. Regional employment data reveals the Western United States recorded a net loss of 61,000 jobs that month. This region hosts significant clusters of professional services and IT industries, with California, home to Silicon Valley, experiencing a net decline of 32,000 jobs. Over 60% of these losses were in technology-related positions, indicating mounting employment pressures for white-collar workers and programmers. This phenomenon is driven by the accelerated adoption of AI technology, as generative AI and automated office systems become widespread in enterprises. Numerous repetitive clerical tasks and basic programming roles are being replaced. A survey by the U.S. Chamber of Commerce revealed that 42% of companies had introduced AI tools to replace entry-level positions in Q4 2023, with adoption rates reaching 58% in professional services and 65% in technology. The impact of these cost control measures is becoming evident. Technology firms within the S&P 500 index recorded a 3.1% year-on-year decline in personnel costs during Q4 2023, the first such decrease since Q3 2020, which has partially bolstered their profitability. Wage growth data similarly reflects structural characteristics of the labor market. Retained employee wages in December 2023 increased by 4.3% year-on-year, remaining largely unchanged from the previous reading and sustaining a relatively low level throughout the year. This indicates companies are maintaining a cautious approach to adjusting existing staff remuneration, while also suggesting overall competitive pressures in the job market have eased. By sector, wage growth among existing employees exhibited a pattern of higher growth in defensive industries and lower growth in cyclical industries. Wages in the education and healthcare sector increased by 5.1% year-on-year, while the leisure and entertainment sector saw a 4.8% rise. In contrast, manufacturing and information technology sectors recorded modest increases of 3.5% and 3.2% respectively. Meanwhile, the year-on-year growth rate for salary increases upon changing jobs rose from 6.3% in November to 6.5%, showing a modest rebound. Two plausible interpretations exist for this phenomenon. From a seasonal perspective, year-end typically marks a peak period for job changes, particularly in seasonal industries like tourism and retail, which often increase salary offers to attract short-term labor. This trend was similarly reflected in comparable data from 2019 and 2020. The growth rate of salaries for job changes in December 2019 rose by 0.4 percentage points compared to November, while in 2020 it increased by 0.3 percentage points. From a technical standpoint, if the anomalously low November figure is excluded, the 6.5% job-hopping wage growth actually represents the lowest level since September 2023, indicating no substantial surge. Regardless of which interpretation holds, December's wage growth data is unlikely to exert sustained pressure on inflation. The steady increase in retention wages indicates insufficient upward momentum for core inflation, while short-term fluctuations in job-hopping wages struggle to generate persistent inflationary transmission effects. This provides favorable conditions for the Federal Reserve's subsequent interest rate cuts. Beyond employment figures, December's services PMI further corroborated economic resilience. The TSMC services PMI registered 50.6, marginally above the 50-point threshold but below market expectations of 53.5, failing to reflect the fastest expansion in a year previously anticipated. The core drivers of this data stemmed from marginal demand recovery and positive employment improvements. Anthony Nieves, chairman of the ISM Services Survey, stated at the time, confidence among service sector firms is slowly recovering, with modest demand growth supporting the job market, though businesses remain vigilant about cost pressures. On the demand front, the new orders index registered 57.9, surging 5 percentage points from the previous reading to mark its largest increase since September 2023. The new export orders index performed particularly strongly, breaking above the 50 threshold to reach 54.2, its highest level in over a year. This indicates that demand growth in the service sector extends beyond domestic markets, with overseas demand also showing clear signs of recovery. This trend aligns with the U.S. Department of Commerce's December service exports data, which showed a 3.2% year-on-year increase. Exports of technology services and financial services grew by 4.5% and 3.8% respectively, primarily benefiting from global digital economic development and rising demand in emerging markets, indicating impediments in the inflation transmission pathway. From a cost pass-through perspective, businesses facing rising costs have opted not to pass them on comprehensively. Instead, they have absorbed cost pressures through optimizing internal management and enhancing operational efficiency. The NFIB survey revealed that 35% of small businesses reported reducing operating costs through process optimization in December 2023, an increase of 8 percentage points from the third quarter. This is also attributable to the current balanced competitive landscape, where most service industries exhibit low concentration, making it difficult for businesses to secure excess profits through price hikes. NFIB data further indicates that only 18% of small businesses successfully passed on the full cost burden, a 12 percentage point decline compared to the same period in 2022. Should import costs remain stable going forward and businesses continue to exercise restraint in cost-passing behavior, the impact of previous tariff policies on inflation may further diminish, gradually drawing to a close. Data from the U.S. Bureau of Labor Statistics indicates that the import price index for goods fell by 1.2% year-on-year in December 2023, marking 5 consecutive months of contraction. Meanwhile, the import price index for services rose by 0.8% year-on-year, with the growth rate moderating by 2.1 percentage points from its peak earlier in the year. Overall, December's macroeconomic data paints a clear picture of structural recovery. The moderate rebound in services effectively counterbalanced manufacturing weakness, while divergent labor market trends and easing inflationary pressures jointly underpin stable economic performance. However, a comprehensive recovery remains contingent upon a substantive manufacturing upturn and further optimization of the employment structure. The semiconductor industry landscape is diverging, with TSMC's capacity emerging as a pivotal variable. JP Morgan has again raised its forecast for TSMC's advanced process capacity within the past 3 months, increasing projections by 8% for 2026 and 13% for 2027. This adjustment fully reflects TSMC's central position within the global semiconductor supply chain and the sustained growth in market demand for advanced process chips. As the world's largest wafer foundry, TSMC's capacity allocation directly influences the development pace and market competitiveness of major global chip designers, particularly in fields demanding extremely high process precision, such as AI chips and high-end smartphone chips. TSMC's capacity supply virtually determines companies' market share. Data from semiconductor research firm IC Insights indicates that the global market for advanced process chips reached $89 billion in 2023, accounting for 28% of the total global chip market. TSMC commanded 72% of this segment, significantly outpacing Samsung's 15% and Intel's 8%. TSMC's new capacity expansion for 2026 to 2027 focuses on 3 nanometers and 2 nanometers processes. The 2 nanometers node employs a gate-all-around GAA architecture, achieving a 15% increase in transistor density and a 15% performance boost or 24 to 35% power reduction compared to 3 nanometers. Wafer pricing stands at $30,000 per wafer. By August 2025, the 2 nanometers yield rate reached 85%. The Kaohsiung plant's P1 facility has a monthly capacity of 25,000 wafers, with P2 scheduled for trial production by year-end. The Arizona production line has been delayed to Q1 2027 due to supply chain issues. IC Insights forecasts the global 2 nanometers chip market will reach $42 billion by 2027, accounting for 35% of the advanced process market. Nvidia's total allocation for TSMC's advanced processes in 2026 remains at 700,000 wafers. Though product portfolio adjustments are significant, mass production of its core Rubin product has been delayed by 1 to 2 months due to HBM for memory readiness issues. The critical bottleneck lies in the 16-layer stacking constrained by package height and wafer thickness, demanding exceptionally high bonding technology. Currently, Samsung, SK Hynix, and Micron are accelerating R&D efforts. Samsung has achieved an 82% sample yield. SK Hynix has attained a data transfer rate of 10.24 gigabits per second. And Micron anticipates mass production commencing in the second quarter of 2026. The production delay for Rubin chips has directly led to a slight reduction in its initial capacity allocation at TSMC, down from the originally planned 350,000 wafers to 320,000 wafers. Meanwhile, demand projections for the GB300 chip have risen accordingly, filling this capacity gap. Its 2026 capacity allocation at TSMC has been increased from 250,000 wafers to 280,000 wafers. Concurrently, the older H200 chip continues to demonstrate remarkable market resilience. JP Morgan forecasts its packaging volume will still reach 400,000 to 500,000 units in 2026. However, these orders will primarily flow to external packaging houses like MCO, thereby not occupying TSMC's precious advanced process capacity. This arrangement underscores MLS's precise strategy in product lifecycle management and capacity optimization. Looking ahead to 2027, as demand for the Rubin Ultra chip strengthens, Nvidia's capacity allocation at TSMC is projected to increase by a further 4%, reaching 730,000 wafers. However, TSMC's Platinum Tier Water Master capacity allocation strategy implies Nvidia's capacity growth will remain constrained. Capacity demands from other clients such as Apple and Qualcomm will also occupy TSMC's advanced process capacity, making this constraint a key variable affecting NVIDIA's future earnings resilience. Google's semiconductor strategy also warrants attention, with JP Morgan raising its TPU demand forecasts. Shipments for 2026 and 2027 are now projected at 3.2 million and 4.5 million units respectively. This substantial increase will be shared primarily between Broadcom and MediaTek. Broadcom is allocated 230,000 wafers for 2026, mainly for producing high-speed interface chips supporting TPUs, while MediaTek receives 18,000 wafers to supply power management chips. At the product level, the TPU V7 Ironwood and V8 series will dominate the market this year and next. The TPU V7 Ironwood is specifically optimized for inference scenarios, offering significant efficiency advantages in low-latency, high-concurrency environments. Its inference performance improves by 30% over the previous generation while reducing power consumption by 25%, making it highly suitable for real-time demanding applications such as AI customer service and autonomous driving perception. Google's collaboration with Anthropic represents a pivotal breakthrough in TPU commercialization. Anthropic announced an expanded partnership with Google Cloud, securing usage rights for up to 800,000 TPU chips at a cost of $5 billion. These will power training and inference for its next-generation Claude large language model, with total computing power exceeding 1 gigawatt by 2026. Previously primarily used internally, this large-scale order elevates TPU into the core commercial computing power arena. Omdia data indicates Google TPU held just 4% of the global AI computing power market share in 2023. Projected to rise to 12% by 2026, challenging NVIDIA's dominant position. More notably, JP Morgan's research report mentions Google's concurrent advancement of a fully customer-owned tool project. This initiative's core objective is to bypass current intermediaries, granting Google direct control over manufacturing processes. This information represents institutional research analysis perspectives, with no official details disclosed by Google at present. From an industry collaboration perspective, Google's partnership with Broadcom represents a loosely bound relationship lacking irreplaceable barriers. Multiple alternative suppliers exist for the high-speed interface chips Broadcom provides to Google. Should Google's in-house tool project achieve breakthroughs, it would significantly impact Broadcom's relevant business. Broadcom's financial reports indicate that revenue from Google accounted for 8% of its total revenue in 2023, with TPU-related chips constituting over half of this figure. This trend reflects the strategic direction of tech giants extending upstream within the semiconductor supply chain to pursue self-reliance in core technologies. Primarily constrained by the mass production timeline of its flagship MI450 product, The Mi 450 chip is scheduled for mass production between August and September 2026. Based on the next-generation CNDA 5 architecture, it employs an advanced process technology poised to break through to 2 nanometers. Alongside the introduction of 3.5D packaging technology and the 5th generation Infinity Fabric high-speed interconnect bus, its technical specifications demonstrate strong competitiveness. With AI computing power increased by 80% compared to the previous generation Mi30 chip, with power consumption control comparable to Nvidia Rubin chip. However, the Mi 450 currently faces multiple technical challenges, including high circuit design complexity, difficult to guarantee production yields, and excessive packaging dimensions. The latter issue is particularly pronounced, with the package measuring 120 mm, exceeding the carrying capacity limits of some mainstream server motherboards and potentially impacting compatibility within certain server equipment. The Mi 450 chip also involves customization requirements for OpenAI, further increasing mass production uncertainties. Analysts caution that in the competitive landscape, AMD's AI chips underperform Nvidia in raw capability and lag behind Google's TPUs in flexibility. Yet its backup supplier status grants it a unique market position. 62% of global AI chip buyers adopt a dual supplier strategy, with 85% of these designating AMD as their alternative to reduce reliance on Nvidia. This positioning means AMD's shipment growth stems more from supply chain security demands than product performance advantages. Precisely because of this backup status, AMD's share price exhibits greater volatility. Since 2023, AMD's share price volatility has reached 48%, significantly higher than Nvidia's 32%. For every unit increase in shipments, the share price may rise by double or even more. Consequently, despite JP Morgan highlighting risks associated with the delayed shipment of the Mi 450 chip, the market maintains an optimistic outlook on AMD's long-term prospects. Its potential for market share growth in the AI chip sector remains promising, with Omdia forecasting AMD's AI chip market share to rise from 5% in 2023 to 9% by 2026. Moreover, tech giants including Meta, Microsoft, and Tesla are actively advancing their in-house chip development. Meta's MT-chip primarily supports internal AI model training. Microsoft's Azure Maya chip focuses on cloud computing power, while Tesla's D1 chip is specifically tailored for autonomous driving systems. However, these companies' in-house chips currently operate at relatively small scales with limited technological maturity, remaining in early development stages. They have yet to exert a substantive impact on the prevailing semiconductor industry landscape. The PCB industry is experiencing simultaneous growth in both volume and price, with copper demand serving as the core driver. Goldman Sachs' latest research report, published in December 2025, forecasts the market for PCBs and related raw materials for AI servers. It revises the 2027 market size for AI server PCBs upwards from $17.4 billion to $22 billion, and the market size for copper-clad laminates CCL from $8 billion to $15 billion. This adjustment implies that between 2025 and 2027, the PCB and copper-clad laminate segments will achieve compound annual growth rates of 120% and 155%, respectively, demonstrating exceptionally robust growth potential as a core foundational component in electronic products. The explosive growth in PCB demand stems from technological transformations within the downstream AI server industry. The primary driver of this shift is the implementation of Nvidia's next-generation VR200 and VR300 rack architectures. These architectures revolutionize AI server connectivity by enabling rapid component replacement during shutdown, imposing high-frequency, high-speed, and low-loss technical requirements on PCBs. The shift replaces traditional cable connections with high-value PCBs. AI servers utilize 3 to 5 times more PCBs per unit than conventional servers, with value per unit surging from $500 to $2,000, $3,000, directly igniting PCB market demand. This substitution process drives both volume and price growth within the PCB industry. While traditional PCBs yield gross margins of merely 15 to 20%, AI server PCBs utilizing high-frequency, high-speed substrates like Rogers materials, increasing layer counts to 24 to 28, and demanding drilling precision of plus or minus 10 microns with interlayer alignment error is less than or equal to 5 microns achieve gross margins of 35 to 40%. The heightened technical barriers have concentrated market share among leading enterprises. Taiwanese manufacturers like Taiwan Semiconductor Manufacturing Company TSMC, leveraging a 75% yield rate advantage for PCBs exceeding 40 layers, have secured a buy rating from Goldman Sachs alongside an increased target price. Dongwu Securities analysis indicates that downstream demand from AI servers, high-speed communications, and automotive electronics will drive comprehensive PCB technology upgrades across materials, processes, and architecture. AI server PCBs require larger hole-to-wall ratios, typically exceeding 12:1, necessitating back drilling techniques. This imposes higher demands on mechanical drilling machines' efficiency and precision while significantly increasing the number of drilling units required per unit area of PCB production. The drilling equipment demand per 10,000 square meters of AI server PCBs is 2.5 times that of traditional PCBs. Technological advancement not only elevates PCB product value, SMEs, lacking core technologies and capital strength, struggle to meet high-end PCB production requirements, leading to market share consolidation among leading enterprises with advanced processes. Goldman Sachs maintained its buy ratings for Taiwanese suppliers including Taiwan Semiconductor, Kimpo Electronics, and Tetech Electronics in its research report, while raising their target prices. This reflects these firms' technological advantages in high-end PCB manufacturing. Taiwan Semiconductor's yield rate for high-layer PCBs exceeding 40 layers reaches 75%, significantly surpassing the industry average of 65%. Notably, increasing technical complexity is driving a downward trend in PCB production yields. The industry broadly forecasts yields will decline from 73% in 2025 to 65% to 68% by 2027. While this shift appears detrimental to PCB manufacturers, it has unexpectedly catalyzed growth in demand for copper-clad laminate CCL raw materials. To meet final output requirements despite lower yields, manufacturers must consume greater quantities of copper-clad laminate. Based on a projected 2027 PCB market value of $22 billion, a yield decline from 73% to 68% would necessitate a 12% increase in laminate consumption. This effect will drive laminate market growth to outpace that of the PCB market itself, creating a synergistic effect of both volume and price increases. As the core raw material for PCBs, the growth in CLP demand stems not only from increased PCB production and yield rate declines but is also intrinsically linked to technological advancements within the material itself. Copper-clad laminates for AI servers require superior thermal resistance, moisture resistance, and mechanical strength to withstand prolonged high-load server operations. Their heat resistance must exceed 280 degrees Celsius, a 50 degrees Celsius improvement over conventional laminates while maintaining 1,000 hours of continuous operation without failure at 85 degrees Celsius and 85% humidity. This necessitates copper foil of superior purity and performance for the laminates. PCB laminates must utilize high-purity refined copper to ensure optimal conductivity, directly impacting the operational reliability of graphics cards and entire servers. Substandard copper foil purity may cause signal transmission delays, abnormal heat generation, and other issues that compromise AI server computational output. Currently, copper foil used in laminate production typically requires a purity exceeding 99.99%. The stability of high-purity copper supply has thus become a critical factor influencing laminate production capacity. Copper prices are expected to receive sustained support. The average element copper price in December 2023 stood at $8,560 per ton, representing a 12% increase from the year's low. Core drivers include, firstly, copper consumption rates for AI server PCB manufacturing reach 18 to 22%, exceeding traditional PCB rates by 8 to 10 percentage points. Secondly, the U.S. copper self-sufficiency rate stands at merely 35%, with the high-purity copper deficit projected to reach 120,000 tons by 2026, while demand from high-end manufacturing sectors such as AI servers and new energy vehicles continues to grow. Although market speculation arose regarding potential copper restrictions under the Trump administration, no official proposals have materialized to date. Should such policies be implemented, they could exacerbate the global supply-demand imbalance. From an industry development perspective, modularization represents the core future trajectory for data centers. Although full hot swappable functionality across all components remains unachieved, the widespread adoption of Humanoid robots and robotic arms in data center operations will inevitably necessitate modular, hot-swappable hardware designs. Research by the International Data Center Association indicates that globally, 38% of data centers adopted modular designs in 2023, with this proportion projected to rise to 65% by 2027. Wiring and cabling, constrained by random variations in shape, position, and orientation, prove challenging for robotic automation. In contrast, modular PCB interfaces enable precise control over positioning and insertion force, with relevant parameters programmable via code. This facilitates fully unmanned operation and assembly, a trend set to further drive long-term growth in the PCB industry and consequently sustain copper demand. The China Non-Ferrous Metals Industry Association forecasts that global copper consumption within the PCB sector will reach 1.8 million tons by 2027. Accounting for 7.2% of total global copper usage, a 2.1 percentage point increase from 2023. Trump's two new policies have triggered market turbulence, with long-term impacts yet to be observed. In December 2023, Donald Trump unveiled a series of radical policy proposals via social media. Among these, two bans targeting capital operations within the defense industry and institutional investors in the property market drew widespread market attention and triggered significant volatility. The backdrop to these policies is closely linked to America's current socio-economic realities. While their short-term impact has already begun to manifest, their long-term effects require comprehensive assessment based on policy implementation progress and industry feedback. A CNN poll at the time indicated that 48% of Americans supported these two new policies, believing they could effectively address industry malpractice, while 42% expressed opposition, concerned that the policies would trigger market turbulence. Within the defense sector, Trump's policy directly targets the capital allocation practices of defense contractors, criticizing their prioritization of dividends over investment. His policy proposal explicitly condemns defense companies for the slow pace of military equipment production and maintenance, asserting that sacrificing factory and equipment investment for substantial dividends and share buybacks harms national interests. He declared such practices would no longer be permitted or tolerated. To ensure policy implementation, Trump introduced stringent measures. Defense executives' compensation shall not exceed $5 million until new manufacturing facilities are operational. This policy directly struck at the core interests of defense contractors, triggering a sharp market reaction. Following the announcement, shares in major defense firms including General Dynamics, Lockheed Martin, and Northrop Grumman fell by approximately 2%. Lockheed Martin saw its largest single-day decline since August 2023, with shares dropping by 2.8%. Trump's criticism is substantiated. Taking Lockheed Martin as an example, in October 2023 it announced a dividend of $3.15 per share and authorized $6 billion in share buybacks. While R&D expenditure increased by merely 3% and capital expenditure decreased by 2% during the same period. This pattern of prioritizing dividends over investment is widespread across the sector. In the first 3 quarters of 2023, S&P 500 defense constituents averaged a 4.2% dividend payout ratio, with $32 billion in share buybacks, while capital expenditure accounted for merely 22% of their budgets. Despite the U.S. defense budget rising to $886 billion in 2023 and defense firms' net profits increasing by 12%. Inadequate capacity expansion and R&D investment have resulted in inefficient equipment delivery. According to relevant U.S. Department of Defense reports, multiple critical defense equipment projects face varying degrees of delivery delays. Some missile systems have extended delivery cycles by 6 to 12 months beyond schedules, while F-35 fighter jet delivery delays reached 18%, an 8 percentage point increase from 2020. Against the backdrop of complex and volatile international security dynamics, this has heightened U.S. government concerns regarding defense supply chain security. During congressional testimony, U.S. Deputy Secretary of Defense Catherine Hicks stated, "Delays in defense equipment delivery pose a potential threat to U.S. national security, necessitating increased capacity investment by defense contractors." President Trump's policy aims to compel defense contractors to redirect cash flow towards manufacturing, thereby enhancing production capacity and delivery efficiency for defense equipment. Long-term implementation of this policy, if successful, would bolster the core competitiveness of the U.S. defense industry, reduce resource wastage and tax revenue leakage, effectively achieving an indirect tax reduction for the populace. The Center for Tax Policy Studies estimates that redirecting share buyback funds towards capacity investment could prevent approximately $4.5 billion in annual tax leakage. However, in the short term, the policy's implementation will directly impact defense contractors' profit distribution plans, potentially squeezing shareholder returns. Taking Lockheed Martin as an example, if it redirects buyback funds into capacity investment as required, its earnings per share for 2024 could decline by 12 to 15%. Concurrently, companies will need to make significant adjustments to their operational strategies, involving capacity planning, R&D investment, staffing, and other areas, which may lead to short-term operational disruption. More critically, the military-industrial complex wields formidable influence within the U.S. Congress, with numerous legislators sharing deep financial ties to defense contractors. Open Secrets data reveals that defense industry lobbying expenditures reached $120 million in 2023, involving 350 lobbyists across multiple committees in both chambers of Congress. Instances of defense firms influencing policy formulation through lobbying activities are commonplace. In 2022, the defense sector successfully lobbied for an additional $30 billion in defense budget allocations. Consequently, significant uncertainty remains regarding whether President Trump's proposed ban can proceed smoothly and ultimately become law. Policies in the real estate sector directly target institutional investors such as private equity firms and real estate investment trusts, prohibiting them from continuing to purchase single-family homes. This policy stems from a decade of institutional hoarding driving up house prices and rents. Between 2013 and 2023, the average price of single-family homes in the U.S. rose by 89%, while household disposable income increased by only 37%, pushing the price-to-income ratio from 2.8 times to 4.1 times. In 2023, single-family home rents increased by 5.2% year-on-year, with cities like New York and Los Angeles seeing rent-to-income ratios exceed 35%, significantly increasing housing affordability burdens for ordinary households. Data indicates that by the end of 2023, private equity firms and real estate investment trusts held 2.8 million single-family homes in the U.S., accounting for 2.3% of the total stock, a 1.5 percentage point increase from 2013. In certain high-demand areas, institutional ownership approaches 30%, such as Dallas, Texas, and Orlando, Florida, where it stands at approximately 28%. Property price increases in these areas have outpaced the national average by 15 to 20%. Concentrated purchases by institutional investors have directly inflated local housing costs, making the American dream increasingly unattainable for many ordinary households. Data from the National Association of Realtors indicates that first-time homebuyers accounted for just 26% of purchases in 2023, the lowest level since 1987. Among these buyers, 62% cited excessively high prices as the primary barrier. In his policy statement, President Trump bluntly declared, "People live in houses, not corporations," explicitly attributing part of the responsibility for rising house prices and inflationary pressures to these institutional investors. Following the policy announcement, shares of institutional investors in the real estate sector suffered heavy losses. Blackstone Group's stock plunged 9% in a single day, wiping approximately $7.5 billion off its market capitalization. Shares of Invitation Homes, the nation's largest single-family home landlord, also fell sharply by 5.8%, reflecting strong market concerns about the future prospects of institutional real estate investors. Regarding the policy's anticipated effects, successful implementation would effectively curb institutional hoarding of single-family homes, increase housing supply, and alleviate pressure on rising house prices and rents. CoreLogic predicts that if institutional investors cease purchasing single-family homes, U.S. single-family home price growth could fall below 2% in 2024, with rent increases also dropping below 3%, undoubtedly a favorable policy for ordinary citizens. However, its practical implementation faces numerous challenges. Beyond institutional investors' influence in Congress, there are disputes over the policy's legality. Some legal experts contend that prohibiting specific types of businesses from purchasing residential properties may violate the U.S. Constitution's principle of fair competition. The U.S. Chamber of Commerce has explicitly stated it will challenge the policy in court. Moreover, institutional investors' withdrawal could inflict short-term liquidity shocks on the housing market. Massive concentrated sales of single-family homes by institutions might trigger significant price volatility in certain regions, potentially undermining market stability. Moody's Analytics forecasts that if institutional investors offload 500,000 single-family homes within a year, property prices in some popular areas could decline by 10 to 15%. Historical precedent suggests that Trump's previous policies targeting pharmaceutical companies ultimately adopted compromise solutions due to industry resistance. His 2020 drug pricing control proposal, originally mandating that drug companies reference international prices for pricing, was significantly watered down to voluntary negotiated pricing following fierce opposition from the pharmaceutical sector. Consequently, these radical policies targeting the defense and property sectors are also unlikely to proceed entirely as initially proposed. They will likely undergo adjustments during negotiations with Congress and industry stakeholders. Regardless of the final policy form, Trump's motivation for introducing these measures lies in addressing core concerns of ordinary citizens. His attempt to use administrative means to intervene in market imbalances has garnered support from certain segments of the population. For the U.S. economy, should these policies yield tangible results, they could help alleviate social tensions and enhance public welfare. Yet improper implementation risks triggering industry turmoil and undermining economic growth. Consequently, their long-term impact remains contingent upon the pace and effectiveness of policy execution. Global asset and market dynamics exhibited divergent trends. In December 2023, global financial markets displayed pronounced fragmentation under the combined influence of multiple factors, with significant performance disparities across different asset classes and industry sectors reflecting complex market expectations regarding economic prospects and policy trajectories. Bloomberg's Global Asset Disparity Index reached 0.68 in December 2023, its highest level since June 2022, and exceeding the 0.5 threshold, indicating pronounced market divergence. U.S. equities broadly declined on the 20th of December, with the Dow Jones Industrial Average falling 1.2%, the S&P 500 index declined by 1.5%, and the Nasdaq Composite Index dropped by 1.8%. Among these, the most heavily shorted stocks and high-beta sectors exhibited particularly weak performance, becoming the primary drag on the market. The weakness in high-beta sectors stemmed from uncertainty surrounding Federal Reserve policy, with the Goldman Sachs high-beta index falling by 2.3% that day, led by declines in the new energy and semiconductor design sectors. Large-cap tech stocks showed mixed fortunes, with Google rising 2.1% while Amazon declined 1.3%. Financial-related sectors weakened in tandem, with banking stocks falling 2.5% on expectations of narrowing net interest margins. Private equity firms faced headwinds from property policy impacts, with Blackstone and Carlyle dropping 9% and 4.5% respectively. The U.S. Treasury market showed divergence, with the yield curve flattening. The 10-year Treasury yield closed at 3.82%, while the 2-year yield fell to 4.26%, narrowing their spread to minus 44 basis points. The core driver was heightened expectations for Fed rate cuts, with federal funds futures indicating an 85% probability of a 25 basis point cut in March and reinforced expectations for at least 150 basis points of cuts throughout the year. Precious metals underperformed, with gold closing down 0.6% at $2,045 per ounce and silver falling 3.9% to $23.50 per ounce. Although lower U.S. Treasury yields typically support precious metal prices, shifting market risk appetite and relative U.S. dollar strength offset this supportive factor. The U.S. dollar index rose 0.3% to close at 102.5, primarily driven by heightened expectations for European Central Bank rate cuts, with the euro falling 0.4% against the dollar. Bitcoin futures declined by 1.7% to settle at $42,500 per coin. Volatility in the cryptocurrency market was primarily influenced by regulatory policy expectations and macro liquidity forecasts. Persistent concerns over tightening cryptocurrency regulations weighed on prices, particularly as the U.S. Securities and Exchange Commission advanced investigations into multiple cryptocurrency exchanges. In the energy sector, WTI crude oil closed down 1.8% at $71.20 per barrel, and Brent crude oil fell 1.6% to $76.50 per barrel, influenced by developments in Venezuela. Uncertainty surrounding Venezuelan oil exports introduced variables into global crude supply. prompting market caution and triggering a price correction. Data from the U.S. Energy Information Administration showed U.S. crude inventories rose by 2.3 million barrels that day, exceeding market expectations of a 1.5 million barrel increase, which also weighed on oil prices. Furthermore, diverging global growth forecasts impacted energy markets. The IMF projected 2024 global economic growth at 2.9%, a 0.1 percentage point downgrade from its previous forecast, fueling market concerns over slowing energy demand growth. The first week of 2026 witnessed novel characteristics in global financial markets, with worldwide bond issuance reaching a record high of $238 billion United States dollars. This reflects investors' heightened risk appetite alongside borrowers' sensitivity to financing costs. The core driver was expectations of global central bank rate cuts, prompting borrowers across the U.S., Europe, and Asia to accelerate bond issuance before the end of the earnings season to lock in low costs. U.S. investment-grade corporate bond issuance reached $72 billion with a subscription multiple of 3.2 times, confirming ample global liquidity. Investment fervor in the AI sector remains high, with unicorn firm Anthropic raising $8 billion at a $320 billion valuation, nearly doubling its September 2023 valuation. The funding round, led by GIC and Coexisting with participation from Microsoft and Nvidia, will finance the procurement of nearly 800,000 TPOV7 chips and the construction of an in-house supercomputing center. This move aims to reduce dependence on Nvidia's CUDA ecosystem and cloud providers' computing power. CEO Demis Hassabis emphasized that this initiative will underpin next-generation large model development, while enabling control over computational costs. Significant shifts are occurring in the financial sector's partnership landscape, with JP Chase replacing Goldman Sachs as the new partner for Apple's credit card. This deal involves approximately $20 billion in outstanding balances and includes over $1 billion in rebates. This partnership shift marks Goldman Sachs' formal exit from consumer lending. The firm's ventures in this sector have consistently failed to meet expectations over the years, with its consumer lending business recording a net loss of $120 million in 2023, its third consecutive year of losses. This withdrawal represents a key strategic realignment, redirecting resources towards its core investment banking operations. Goldman Sachs CEO David Solomon stated in an internal memo at the time, "Focusing on our core businesses will help enhance the company's profitability and operational efficiency." Meanwhile, Apple continues to deepen its financial services footprint through its partnership with JP Chase, the Apple Card. Leveraging its deep integration with the Apple ecosystem, has already amassed over 10 million users. This collaboration will further enhance Apple's financial services competitiveness, with JP Chase set to provide Apple Card users with more diverse installment products and rewards redemption services. Finance, geopolitical tensions continue to impact global assets. The Trump administration announced indefinite controls on Venezuelan oil exports, with proceeds deposited into U.S. accounts for Venezuelan economic reconstruction. The U.S. has commenced marketing Venezuelan crude and is facilitating Chevron's assistance in restoring infrastructure. Venezuela's 2023 oil exports stood at 1.2 million barrels per day. Changes in control over these exports will reshape the global crude supply landscape. Producing nations such as Russia and Iran have expressed concern and may adjust their export strategies, potentially impacting energy prices and related asset performance. Key policy and market insights with investment implications. The global economy currently navigates a complex transition phase, where the interplay between U.S. macroeconomic policy direction and market dynamics constitutes a core variable influencing investment decisions. Among these, the December 2023 non-farm payrolls data represents the most critical near-term focus. Its performance will directly shape expectations regarding the pace of Federal Reserve interest rate cuts, thereby exerting broad implications across global financial markets. Combining previously released ADP employment figures and services PMI data, market expectations for December's non-farm payrolls centered around 170,000 new jobs, with the unemployment rate holding steady at 3.7% and hourly wages rising 4.1% year-on-year. Actual data showed U.S. non-farm payrolls increased by 199,000 in December 2023. The unemployment rate remained at 3.7%, and hourly wages grew 4.1% year-on-year. Examining the data in detail reveals two key characteristics. Firstly, the services PMI employment subindex surged from 48.9 to 52, coupled with robust ADP services employment figures. This indicates sustained resilience in the services sector within the non-farm payrolls. Employment growth in education, healthcare and leisure, entertainment sectors underpin the overall data, with education, healthcare adding 78,000 jobs and leisure, entertainment adding 42,000. Secondly, persistent weakness in goods-producing employment and layoffs among white-collar workers in the western region exerted downward pressure on the overall non-farm figures. Goods-producing employment saw a net decrease of 12,000 positions, while western region employment declined by 61,000. Consequently, although the actual data exceeded expectations, it did not indicate overheating. Subsequent analysis by the U.S. Bureau of Labor Statistics highlighted that these figures further confirm the structural divergence within the labor market, providing data support for the Federal Reserve to maintain policy flexibility.